Hi, it's Eric Nuttall of the Ninepoint Energy Strategies. It's time for the weekly update. Let's talk OPEC. We finally got the outcome of the deferred meeting. Universally bullish outcomes despite a very muted reaction in the oil market. So what did OPEC decide on, and the voluntary members of the one of the cuts at least? What we got was a deferral by 3 months. So the voluntary members, those 8 countries voluntarily reducing production, will bring those barrels on in April as opposed to January. Why is that important? Q1 is the seasonally weakest period of demand, and so it shows that OPEC is not going to push barrels onto a market when balances wouldn't allow it. Secondly, they announced that the return of those barrels will last over an 18-month period versus just 12. So it's elongating the return, it's reducing the monthly stock builds, and giving the ability of compliance barrels to further erode oil inventories. And then lastly, what we saw was the UAE, which had an agreement to be able to increase their production owing to an increase in capacity, that also got deferred by several months. And so that speaks to the increase of cohesion. And this narrative that's been promoted in certain medias about faltering OPEC cohesion, and there's infighting between the UAE and Saudi. I really believe that the announcement today should put that to rest. And so where do things stand? As we look to 2025, we're entering into it with record high oil demand, record low global inventory seasonally. The market remains bearish on 2025, largely owing to balances due to non-OPEC supply growth expectations. Those largely include Brazil, United States, and Canada. When we look at those constituents then, Brazil has been a massive disappointment this year. They've produced by about 350,000 barrels per day, and they're expected to be 30% of non-OPEC supply growth next year. And so there's a possibility that expectations there are too high. As we look to the United States, U.S. shale production is growing this year at its slowest pace since the rise of U.S. shale, other than during COVID era, as well as when you had the Saudi spanking of 2016 when they dropped a price to try to assault the pace of U.S. shale growth. And so why is U.S. shale growing so little? We think it's evidence that shale has entered into its twilight. And as we look to not next year, but 2026 and beyond, relying on forecasts from Energy Aspects, whom we rely on, when we look at the expectations for non-OPEC supply growth, effectively after next year, we'll enter into a period of time when non-OPEC supply grows less than demand in 2026, and there's almost no growth in 2027, 2028, and in declines in 2029. And that's kind of a forever situation, owing to the long lead nature of projects, the inability to spend on upstream, ESG pressures, divestments. All of these things are finally coming to a head. And so we think today's action on OPEC speaks to their ability to play the long game. They, like I, believe that the demand for oil will grow longer and stronger than current consensus believes. They see the twilight of U.S. shale with the belief that gravity will take care of itself. They see the inability, and in fact, I think they're concerned about the drop-off in non-OPEC supply in a couple of years' time, because it's not that far away. Like 3 years' time, 2027, 2020 is not that far away. And so their decision to remove barrels today, to bring them back on at a later date when market conditions will further demand them, and when likely prices will be, I think, meaningfully higher, speaks to their ability and their resolve. So we could view the OPEC decision universally bullish. It is the kill shot to any concerns about the worry about losing market share to U.S. shale, lack of cohesion, faltering deals and whatnot. And we think it does speak to the leadership of His Royal Highness, the Minister of Energy of Saudi Arabia, who commands the respect of the market. And so that's our weekly wrap. We remain more bullish than consensus on the outlook for oil heading into 2025. We recognize that demand has not grown as much as we would have thought earlier this year, largely due to China. But when we look at expectations for supply growth next year, we think they are too optimistic. And as we look to 2026 and beyond, the balances will meaningfully tighten. And so we don't think we're that far away from the market being able to look through excesses, perhaps excesses of 2025, to a market that is chronically undersupplied 2026 and beyond. Thanks so much for your attention. We look forward to chatting again soon.